How we doing, traders? Welcome back to Stock Market Movers. I'm excited to get into today's show. There's so much to talk about. Normally, I get to the point where I'm scrounging a little bit, looking for some topics to talk about. But today, it just seems like, wow, there's a lot of news out there today. We'll get into all of it. There's a lot of Fed talk out there. We'll talk about a lot of OPEC Plus and oil news that we definitely need to keep a watch on. We'll talk about some earnings. We got Constellation Brands, McCormick. We'll talk about recession concerns that are out there. Ford increasing their F-150. Costco numbers coming out. Peloton coming out. The Twitter saga continuing. A lot of analyst rating changes out there moving stocks. We'll try to get through all of them right here in a 1 hour period. And of course, we got our guest today. We got Joanne Finley, ACM portfolio manager and partner at Advisors Capital Management. That's going to be at 1:15. And then at 1:45, I got you guys an oil expert. We'll talk to Rob Thummel, senior portfolio manager and managing director at Tortoise Capital Advisors. So we're going to talk to an oil expert today. We'll talk about the overall market. We got a lot on the plate. Let's get it started. Welcome to Stock Market Movers. I'm your host, Money Mitch, and let's start the show. There are 3 ways to make a living in this business. Be first, be smarter, or cheat. I can't help you cheat, but I can give you the informational edge to help you succeed in the markets. Welcome to Stock Market Movers. All the market moving headlines and expert opinions every day. They say money is the oxygen of capitalism, and I want to breathe more than any man alive. All right, traders, let's go ahead. Let's get into the market. Let's first take a look at the overall market before we get towards our topics on the day. You can see the SPY has been hanging out in this kind of hourly range. This is definitely important to keep on watch. We're going to see what happens. When will it get out of this hourly range? Right now, it's been holding on here. Let me try to expand this a little bit so you guys can see it. There you see it. It's been hanging out from around the 378 on the top end towards 372 on the bottom end. There's some change there. You guys can get in here. But one thing that I did see is that there's multiple times to break through it. We tried to do it right at the open, and we got up there at the 10 o'clock and we couldn't hold above that 378. We got out as high as 378.72 and then came back down. But we haven't broken through that 9 a.m. low. I think that 9 a.m. low is definitely vital to holding on right now. 374 is that level. And you take a look, we're going to go a little bit closer towards today's action here on the 15-minute. You guys can see around the 374 is where we've been bouncing off multiple times. If that level gets wiped out, I'm going to be concerned about this rally. But if it can hold that level right there, that 9 a.m. level on the hourly, I have a feeling that you can eventually get that rip right back up through that 378 and continue the bear market rally. Now, the question is, right, is this a new bottom? Of course, we'll talk about that with our guest coming on up. But let's get towards the topics today. There's a lot of topics to talk about. First thing, let's talk about some of the Fed comments that are out there. There's a lot going on, and the Fed seems like they just want to keep, coming out and having these speeches. So we're going to keep having these kind of waves. What has happened recent? Well, Fed Kashkari said that interest rate hike pause is quite a ways away, stating that until I see some evidence that the underlying inflation has solidly peaked and is hopefully headed back down, I'm not ready to declare a pause. I think we're quite a ways away from a pause. That coming from Fed Kashkari, adding to yesterday's comments by Atlanta's Fed President Raphael Bostic, who said that the central bank is probably in the early days of the fight against inflation. So more comments, of course, iterating what the Fed keeps telling us, that their goal is to fight inflation. As much as we're trying to pivot quickly away from this, it seems like the Fed has been consistent in their message here. And I think Kashkari is clearly telling us here that they're not thinking about pausing in the next meeting. him saying here, I think we're quite a ways away from a pause. I wouldn't expect to see it in the next meeting. So I know that some people were thinking that maybe the Fed would, change their tune a little bit. I haven't seen that yet. But let's get out of the Kashkari comments and the Fed talk today. Let's go towards the battle right here that's going on right now. And so there's a battle right now, and the battle's between the White House Strategic Petroleum Reserves and OPEC Plus. And what's been going on? Well, yesterday we got OPEC Plus to make that decision to reduce the production by 2 million barrels per day from November. And what happened here? Well, the battle back, right? Biden had directed the Department of Energy to release another 10 million barrels from the Strategic Petroleum Reserve to next month. And now the battle's on, right? I mean, Biden and the administration are trying to figure out options. We'll talk about that with our guest coming up, so don't miss that. That's going to be coming up at 1:45 while we talk to an oil expert. We'll get into all the conversations on what questions a lot of investors are asking. What happens to the price of oil moving forward? What can the White House do? What are the options here? And of course, we'll take a look at some of the major oil stocks, see how those are performing and what he sees out in the oil market. Let's get through the battle between the White House and OPEC Plus. Let's keep going towards some other headlines that are moving some stocks out there. We got a lot going on right now. Well, Google today announced a new kind of iPhone, a new Pixel watch. And of course, the Pixel 7 and the Pixel 7 Pro phones came out, but also announcing a watch. So let's take a look at Google or Google, whichever one you want to take a look at. And you can see we're bouncing and not having a bad day. These were charts that were really causing concerns for me because the way that they were breaking down did not seem great. And Google, I put next to, Microsoft, also very similar charts that were starting to really break down. Microsoft was more of a concern for me because I could see that long-term trend just really snapping, but same thing that I kind of see in Alphabet. Now, of course, they're coming out with new products, trying to help here. But the question is, does anyone feel that these products are better than their competitors, right? Well, it seems like the Pixel hasn't ever really caught on, let's say, towards those iPhone users. I haven't seen many iPhone users tell me that I'm switching from an iPhone to a Pixel phone. So we'll see how this performs. Of course, they're pre-ordered today and will hit the shelves on October 13th. So if you're looking to see about those Pixel watch and the Pixel phone, well, check it on out, the Pixel 7. So it's not like it's their first phone, but let's see if they can actually steal some of the market share back from, of course, the iPhone, or maybe even just come after Samsung a bit with their Galaxy line. All right, let's get out of the Google talk. Let's take one more headline here before we get into our first interview. Now, one thing that I wanted to talk about is what's kind of the situation that I was seeing develop, right? Well, we tried to reach out to Giles Coughlin here to talk about the UK shadow banking system. And I think this is an important thing to keep in mind because a lot of us are starting to see headlines out there of financial instability, right? The Bank of England coming in and trying to save the pensions. It looks like they were just hours away from big concern. So let's talk a little bit about the comments that I got from Giles here. Of course, Giles Coughlin, HYCM, Chief Market Analyst. We've had him on the show plenty of times. I've reached out to get some of the comments. He said that Britain's shadow banking sector is smaller than the certified banking system and provides a way for borrowing at lower rates. But lending at higher ones as such, the sudden rising of interest rates that we have seen lately, we're always going to put the shadow banking business model at risk, especially if people as a lender lent to are no longer in a position to repay those loans. Obviously, this has increased the stress levels in the industry. However, as a relatively small part of the UK's wider financial infrastructure, the impact of such stress has not been felt to the extent that it might have been if normal banking institutions were facing comparative challenges. Indeed, that the added regulation of the regular banking sector is designed to avoid these nightmare scenarios that could lead to major defaults with no capital buffers. So one thing that, of course, the Bank of England did here is they did save a lot of the major banking sector, but now we need to kind of keep watch what happens in the shadow banking system model. Will those kind of get into play here and get more questions of financial instability? This is one area that we're definitely seeing play in Europe. Now, the question will be, I think, really, what ends up happening with the Fed here? Do they see some instability? I think that that's something definitely that could change the Fed's tune. But for right now, I haven't seen it really truly show up here in the US. But across the pond, it seems like financial instability started hitting. All right, let's go towards our guest today. Like always, one of the things that we want to do here on Benzinga is always try to get to the expert opinions. And there's one thing that I can take a look at about what's moving on there. But truly, our competitive advantage is getting to these guests that can go ahead and have the floor. On other medias, they're definitely going to get run off quickly. So here we have an opportunity to go ahead and ask questions. And you in the chat, you get an opportunity also. So make sure that you guys drop a question in the comments there, and I'll make sure to get a question or two from the chat. Let's get into our first interview today. All right, let's bring on Joanne Finley here, ACM Portfolio Manager and Partner at Advisor Capital Management. Welcome back on.
Hey, Mitch, good to see you again. How you doing?
It's good to have you on, and I know that you probably caught my comments there and looking at the Bank of England and what's going on across the pond. But let's focus a little bit on what we've been seeing the talk out there. Everyone keeps thinking that the Fed will pivot. And even this morning, we heard comments from Fed Kashkari saying that they're quite a ways from even a pause. So what would it truly take for the Fed to pivot?
A lot more data than they're likely to have in the next few months. So people that are expecting them to hint at a pause or pivot anytime before next year are far too optimistic. This inflation problem is a very, very challenging one. The typical tools at the Fed's disposal really don't give them a lot of control over the forces that are driving inflation now. And those are really threefold. One is one we're already familiar with, right? The supply shortages that started with the pandemic and have yet to really be resolved, and the supply chain problems. And China's still doing zero COVID lockdowns. That's constraining worldwide supply of various goods. And the second one is that consumer demand still remains very, very strong because of the balance sheet buildup, the clearing of debt that they were able to do during the pandemic when they couldn't spend a lot. But thirdly is another problem that's really going to be a long-term problem, which is the shortage of labor in this country, right? We really actively discouraged legal and illegal immigration in this country for several years now. And that was a big source of the growth of the labor supply in this country that has just gone away. Plus, you have a lot of people that exited the labor market because of the pandemic for health reasons, early retirement, and a lot of them aren't coming back. Women left the labor force, and a lot of them aren't coming back. So we have a real labor shortage. And the reason why that affects inflation is, number one, it constrains the amount we can produce, both in goods and services. But secondly, it also means that firms are having a hard time finding workers, and so they're pushing up wages, and that gets fed into the cost of production, and that gets passed on to consumers in the form of higher prices. So it contributes to the supply shortage, and it contributes more directly to inflation by raising wages. So these are three problems. The Fed can really only act on demand, right? They can't fix the labor problem. They can't fix supply chains. And so what they're trying to do is dampen down consumer demand by raising interest rates, making it more costly to finance a house or a car or a big furniture purchase, maybe discouraging firms, but they don't want to discourage firms because those are the ones that are helping solve the supply problem. So it's a really hard problem for the Fed. And as we know, and as Kashkari and others have said, Mary Daly was on yesterday talking about this, is that they need to see not just the historical data turn and show that inflation is coming under control, but they do a lot of on-the-ground research too. They talk to business leaders, they talk to households, right? They're trying to find out current data to see whether the forces driving inflation, supply chain, labor shortages and wages, and household demand, whether those are actually moving in the right direction. So people should not be hoping that there's going to be any signal of a pause when they meet over the next two meetings.
Now, of course, you've
Sorry.
mentioned it here about the labor situation, right? And I think that we've clearly heard the Fed mention multiple times that they expect to see unemployment start ticking up. Do you expect to see that? Because it just seems like no matter what they're doing, it's not really having too big of an effect right now on the labor market that we can see.
Yeah, it's early still. As is famously known, monetary policy acts with long, and variable, that is unpredictable, lags. It's going to take some time. And, given that firms are still suffering a shortage of labor, it's likely that the impact on consumer demand happens before we see an impact in terms of firms backing off of hiring. There's still a lot more job openings than there are people looking for work. So unemployment, will probably eventually rise, but I think we're going to see the impact of the Fed's moves on spending before we see the impacts in the labor market, which is kind of a good thing in some ways. It means that supply is still going to go up. Firms are still going to hire people, right? Some hotels right now can't operate all their rooms because they don't have enough cleaning staff. As they hire more people, they'll be able to, keep more capacity out there available. And so, more supply is going to help solve the inflation problem. And so we actually would like to see the unemployment rise later rather than sooner, so that that supply problem can ease at the same time that the Fed is really working to bring down demand.
Are you worried about quantitative tightening potentially causing another financial incident?
No, no, we don't have the problems in financial markets that we had back in the late 2000 noughts, right? Because in that case, risk wasn't being appropriately priced or measured, right? When they took mortgage-backed securities and they split them up into these tranches and then labeled things AAA because they were geographically diversified, regardless of what was going on with credit quality of the borrowers, for example. And they made things AAA that were far from AAA, right? That was a problem of regulation, of innovation in financial markets getting way ahead of regulation. And so there was far too much risk being taken. We're not in that situation now. If you look at credit quality of the average home borrower today, it's very, very high, right? So we're not in danger of, the Fed tightening by, reducing their balance sheet, of causing a liquidity crisis, that could break something. So now, and they'll be more gradual about that. I mean, they know they put a lot of money into the system. They're going to take some out gradually. If anything, that'll simply affect the long end of the yield curve. That is, potentially long-term interest rates might move up a little bit more. But given the outlook is for a recession, that kind of tamps down the potential for the 10-year to really rise much further.
Now, we just had this recent rally, and I'd like to have your idea if you feel, this is a dead cat bounce, bear market rally, and what kind of signs could we be looking for a more significant rally? What are the signs that we should be watching for?
Yeah, I mean, those terms don't mean a lot to me. We're long-term investors. What we ask is, are stock prices today, for the stocks that we want to buy, below the intrinsic value of the companies, right? And if we get a rally, right, these sort of micro market movements, are driven by all sorts of things. The last, couple days earlier this week, potentially people started changing their views on the Fed, and there was a lot of short covering, and so you get this real spurt of demand, and you get this reallocation of prices. The real question for investors out there, right, is number one, what's your time horizon? If you're investing for what your portfolio will do for you a year, 2, 3 years, 4 years, 5 years out, then what you're looking at right now are some very attractive prices of very good companies. Some of these stocks that we really like, and I can look right at my Bloomberg screen here, are down 30, 40, 50% from their 52-week highs, or even year over year after we came off the highs of last year. These are really good opportunities. Again, do your research, be careful about selection. But, a company like Broadcom, for example, I think I probably talked about that last time I was on. one of my favorite companies because they are so well diversified and so well run. They're a market leader in all of their areas in which they choose to participate. And the stock is down 25 something percent, year to date. That's just an incredible opportunity for an investor. Plus, they pay a dividend and they raise it every year. So, instead of thinking about, well, is there going to be another short-term rally, but might the market pull back? Just think about if you buy these companies now, are you going to be happy with the cost basis 3 years from now? And I'll bet you will be if you stick to good quality companies with solid balance sheets and, growing in a secular way as opposed to cyclical, growing end markets.
I agree. I mean, at the end, it looks like in the short term, we definitely have volatility that will be there. In the long term, there's great potential to find a great at value stock here, right? I mean, there's some stocks that have come down 80, 90%. And I think that this is the time where investors can really, especially if you came in kind of that, boom in 2020, can actually start looking at some valuations and seeing what makes sense to them. Now, one question that we have in the chat, this is coming from Dan Smith, is who's going to buy the treasury bonds if it's not the Fed?
Oh, no, they are not the main buyer. It is a tool that they use to get in and out of market to control liquidity, but they're not the main buyer, right? International banks, for example, corporations, right? So a corporation on its balance sheet has to have a certain amount of liquidity. And they want safe liquidity. So they typically own treasury bonds and treasury bills, depending on the maturity structure they want to have on their balance sheet. Other central banks around the world hold dollar-denominated assets. It used to be the case that the Netherlands was the biggest owner of treasury bonds and bills. I'm not sure now, if you rank them, the Netherlands, China, Japan, other countries. So those are the main holders of treasuries.
Now, are you worried about the upcoming earnings season?
Yes. Absolutely. We should all be. Earnings estimates have come down, right? So back in the middle of July, right when we were having that fun little summer rally, earnings growth for this past quarter, for the third quarter, for the S&P 500 was expected to be around 10%, 9 or 10% year over year earnings growth. That is now 2.9%. So people have recognized that there are a lot more challenges for firms of all different stripes outside of the energy sector. Because consumer demand has fallen a little bit because inflation in costs is eating away at profit margins for some of those companies. Some are able to pass on those cost increases, and so finally we've seen the sell side analysts take down their numbers for earnings growth for the third quarter. But and so when companies report, clearly there's a lower bar for them to clear in order to satisfy the investor public. But I think that this earnings season is going to be more about guidance, and not just guidance for the fourth quarter, for this quarter. It's really going to be looked at for the signals companies give and the insight they may be able to provide as to what they see happening next year. And, we're only in October, so any comments the companies make, those comments are still going to be a lot of guesswork. But what we want to know is, are companies becoming more cautious in the investments they are making into hiring, into factory capacity, into other expansion plans, or are they contracting? We see a lot of headlines, Peloton and Facebook and other people cutting jobs. They were all the pandemic darlings. They had to expand to keep up. And Amazon too, they had to massively expand their warehouses. So we're seeing that. What we want to know is more broadly, are the big conglomerates, are the big broadly exposed companies starting to pull back a little bit on their investments for next year? Nobody knows if a recession is going to come in the U.S. We're not in one now, but labor market remains pretty strong. But I think that's how the earnings season is going to affect markets. It's going to be more about what companies say qualitatively about what they expect more for next year than even for the rest of this year.
If that's your earnings outlook, how do you feel that the end of the year outlook looks for, let's say, for the S&P 500?
Yeah, tricky one to forecast, which is why, trying to time these markets and say, well, let me get out ahead. I've had people ask, should we get out ahead of the election? Should we get out until the end of the year? I don't know, because we see these surges now and then, right? Sentiment changes. We could have a change in the situation in Ukraine. right? We could have change in the energy situation in Europe. We just don't know enough about the likely new shocks coming up. And we could have positive economic data, right? We could see a slowdown in inflation over the next couple of reports. We could see a slowdown in hiring, right? And that would, make people more encouraged that the Fed won't have to increase so much next year, which is really what the debate ought to be about, not this year. So, one of the concerns about the rest of the year for the market as a whole is, first of all of those data points that might come our way, geopolitical and economic. But a second thing is that there's been so many losses, right? The stocks have fallen so much. There's a big opportunity for individual investors to take tax losses, right? To realize the losses that they've had, to offset. Perhaps they had a big concentrated position in Amazon. Perhaps they did really well in Peloton or something, and they want to trim that position. Well, a lot of times people are reluctant to get out of these big concentrated positions because of the capital gains. This year, they'll be able to sell out of positions that have a big loss to offset those gains and really have a chance to rebalance their portfolios and make them more diversified. So the danger is that as we get into particularly late November and December, we're going to see a lot of tax loss harvesting going on, both individuals and institutional money. And that could put further downward pressure on the stocks that have been most beat up this year. But then again, maybe not, because it could be the case that tax loss harvesting has been happening all year long because those sell-offs happen so early in the year. Another one of those things, very hard to predict. So again, that's why don't try to invest for the next 3, 4, 6 months. Invest for 3 years out.
Love it.
A lot of your audience, Mitch, right? You got long enough time horizon.
Yeah.
Right. Don't try to make a killing in the next 6 months. Think long term.
Yeah, I mean, if you're trying to predict 3, 4 months out, it's hard to predict one day out right now with these overnight catalysts that just keep coming on in. So it's hard to get through that, let alone look at a year-end outlook. Appreciate you coming on today, Joanne Finley, ACM, portfolio manager and partner at Advisor Capital Management. We'll definitely have you back on. Appreciate the outlook.
Good to talk to you, Mitch. Take care.
All right, let's go ahead. Let's keep going. That's what it's all about. And you heard there, and I think that, she's definitely right on, especially when you look at what the Fed is doing to try to fight inflation. I mean, really, they're very limited in their tools. And I think we can clearly see that when we're looking at the inflation data. They've been trying to knock this down all year long. Have they gotten really far in that knockdown? Well, I mean, you guys can see it from the CPI readings and the PCE readings. It just doesn't seem like they're having that fast of an effect on inflation, as all investors out there seem like they want it to happen, right? Everyone wants inflation just quickly going down. The truth is the stickiness has stayed. And so we need to continue watching to see what happens. And at least from what the Fed keeps mentioning, doesn't look like they're going to change tune anytime soon. And I feel Joanne kind of reiterated that also there. So we'll see what happens. Yes, we're getting rallies, but is the Fed truly pivoting? It doesn't seem like it's anytime soon. Let's keep going. Let's go to some headlines out there. I did see the chat talking about treasuries. I see you guys in the chat. If there's anything that you guys want to talk about or focus, feel free. This is why you guys also run the show. Let's get into some other headlines that are out there. I think we've already mentioned about OPEC. We talked about the Fed talk. We also went into a headline today on Google. Now let's go ahead and let's get into some of the earnings talk that's out there right now. We got some earnings that come on this morning, and then definitely pay attention afternoon. We will get Levi Stratus to come in after the market. But let's go to some of these earnings that came in today. Constellation Brands is the first one. Let's take a look. STZ would be the ticker. Let's see how it performed on the intraday action. So it looks like we're bouncing back a little bit. It did have a little spike this morning on the release. Let's talk about what they came in with. So their earnings came in with a beat and a beat. EPS at $3.17, beating the $2.81 estimate. Sales at $2.65 billion, beating the $2.51 billion estimate. They do see full year 23 EPS at $11.20 on the low end and $11.60 on the high end. Their estimate was at $11.05, so raising the outlook here, Constellation Brands. Now, this is one of those stocks that right now, it just seems to me like it's hanging on, and that it is. You can take a look here from the kind of the daily outlook that I have drawn. You see multiple runs up there. Now, also look to see if it breaks 230. I think you got to go on a chart like this because it can easily just be right back down towards the 215s. And it seems like, they've been going after everything, even value names. So we'll see what happens here in Constellation Brands. But definitely needs to start making its way back towards the 245. We do have the 200-day moving average around 239.61. So that's a level that I would be watching first to recover. And then I could get into more of a bullish tune. But if that doesn't recover and you're starting to see all the moving averages above the price action, that shows me negative here. And you got to be careful. Even though they gave us decent guidance here moving for full year 23, we'll see what happens here. Constellation Brands. All right, next one up, McCormick. Let's go to McCormick. McCormick. All right, sorry about that, guys. MKC. I don't know why I wanted to do the other one, MCK. All right, let's go to McCormick Company here. Q3 EPS coming in at 69 cents, missing the 94-cent estimate. Sales at 1.6 billion, missing the 1.78 billion estimate. They did reaffirm full year 22 guidance. Got a little bit of lift, even though on the report it kind of came down a little bit. Found some bounce into the open. It did make a nice little push right out the gates, but hasn't made that next step up now. It's just going sideways here, so a little bit sleepy. That's not bad levels to look at on the hourly. You can see here how we're just kind of sleepy around that 73.50 area. We'll see if it can take that next step up. It's not a bad looking chart on the intraday action. Now let's take a look at the daily action. Daily action has a lot of bottoming around this 73.65 where we're looking at, but it's already gone to the next level down here. And you can see here, we found a lot of bottoming around the 71.27. So we'll see if this can come back. As you can see though, these have even fallen off the tape, and a lot of that coming in May and down to where we're at. So down about 26%. Even the value names got sold off. And that's what I saw in the recent sell-off, right? In the most recent sell-off, growth and value got hit. And when they all get hit, we got to be careful because it seems like we're continuing through lows. So until we get back through, I would say 76, 77, I wouldn't be looking at McCormick. But like always, you guys make your own investment decisions. It looks like it's trying to hold on the day. We'll see if it's able to hold on. 73.50 is a good level to look for that to kind of hold here and then make that push. Did do a push out the gates. We'll see what happens. How's the overall market looking? Looks like we were trying to hold on to that 374. Will we test back down there? Not an area that I would want to see tested again. And if that happens, the hourly pattern could start breaking down and we could go down towards that 372. Wouldn't want to see it back down there. Let's see what happens today. All right, getting out of McCormick, let's go to some recession concerns that are starting to show up. And, some of these are going to be more concerning than others, but you guys weigh in. Let me know. Are you worried about these companies? Tell me what you think in the chat. All right, first one up is going to be Ford. Ford increasing the entry-level price of its electric F-150 Lightning pickup truck by $5,000 for the 2023 model year due to rising costs and supply chain issues. How many times are we going to continue hearing this same kind of mention? Rising cost, supply chain issues, consistently given in the auto industry. This shows me more and more that inflation, has it truly gone away? No, it hasn't. It's still sticking around. It's being stickier than most would want. Let's talk about the F-150 Lightning pickup truck here. Starting price for the 23 Lightning Pro model will be at $51,974, up nearly 11% and 30% increase from the truck's $39,974 price in May of 2021. So in just about a year and a couple of months, a year and 5 months, we've gone up 30% in the cost of that pickup. That is really signs of concern for the auto industry. How are they going to be able to meet deliveries that they expect to happen if the vehicles are going up by 30%? If that's what's happening and it's happening around in the auto industry, they're going to struggle in a recession, because as recession come, will be more and more concerns about what? Just meeting the average daily spend, paying rent, paying the food. What? The car? Okay, I don't think we're going for a new car if it's going to double our payment increase, right? Most cars back, we're at the $20,000 to $30,000 vehicles. There's not many vehicles that, the average consumer has. It's over 40,000, let alone here coming in at 51,000. And you guys have heard me speak about this before. Kelly Blue Book talking about the average sale of a new car at $48,000. The truth is, the only way the consumer is going to keep going out to these vehicles is if we get a massive, massive tax credit incentive. So unless these car companies like Ford, GM, and Tesla are going to actually start giving some incentive to buy, I'm going to start expecting to see their deliveries just fall off a tape. So that's concerning for companies like Ford, concerning for companies like Tesla, concerning for companies like GM. What will happen in the future? We'll see what happens. GM getting hit. Tesla, will that get hit? It's going to be concerning in a recessionary time. Let's go to the next one here. Let's go to Costco. All right, Costco. Let me know if you guys shop at Costco in the chat. Just throw up the cost in the chat. Let me see what you guys think. All right, let me catch up what you guys are looking at for the Ford. Thoughts on Levi's earnings? I got you, Pat. We'll leave that towards the end, but I'll take a look at what their estimates are, and I'll give you a look there. J Powell coming for your sector. Nowhere to hide, says Dan Smith. Can't blame you for that outlook. Any thoughts on Ford? You guys can definitely throw it up there, but let me know. Would you guys buy a vehicle at $51,000? I know I'm not doing it, at least not right now. All right, let's go to the Costco report here, as they reported their net sales for September, and at least it didn't come in bad here. $21.46 billion, up 10.1% year over year. Comparable sales up 8.5% year over year. But of course, what are they running into? They're running into, of course, trying to deal with the inflation in hourly employees, which accounts for about 90% of Costco workers earn more than $25 an hour on average. So this is what they've been dealing with. They have gotten a little bit better in their shipping and commodity prices, as that has declined. But quoted in the Wall Street Journal is the CFO stating that they're not in a position to pass this savings right now to their customer. A lot of it, the pressures that are coming from, of course, the wages increases, and of course, inflation overall still having an effect on the company. But Costco getting a little bit of lift today, went up there towards $4.94, and this has really started to come back. It already filled kind of that earnings gap. Now the question is, will it take that next step up and try to get back towards the 500, an important price point that I've been looking at in Costco? We'll see if we can make our way back and start making our way towards the 200 moving average at the 518.42 right now. And of course, as it starts going up, we'll see if it can get back through the 500. Nice little bottoming action here. Wouldn't want to see it get to 470 again. Has kind of a rising wedge here. And so we'll see what happens here. Will we get back up towards the 500? Will be an interesting chart to watch. All right, getting out of Costco. I have one last recession concern before we get towards our next interview. And this one coming from Peloton. And so let's take a look at Peloton's chart on the day. It's in the green. And you guys let me know what you guys think about this headline here. The headline came in, and this was from the Wall Street Journal. CEO Barry McCarthy said that Peloton has 6 months to show it can survive as a standalone company. Now, Peloton also did make a plan to cut 500 jobs or about 12% of its workforce. This was reported by the Journal, and that's giving it a little bit of a lift there, the cutting of the cost. Now, I'd really be a little bit more concerned if I was a long-term investor in Peloton when my CEO makes comments like 6 months to show it can survive. That's a little bit scary for me. I definitely would be worried if my CEO was making comments like that. So, of course, we'll see what happens with Peloton. They have been making moves recently. They got put into Dick's Sporting Goods. They mentioned on the Hilton that they would at least have one of their bikes in each of their hotels by the end of next year. So we'll see what happens with Peloton if it's ever really ready to turn around the story. It's been getting a bounce in the last couple of days. We'll see if it can actually hold this and get into the $9 handle. Right now, it's battling. It's trying to get through that Tuesday high, which is 886. And you can see right now, 884. We'll see if we can close above that. All right, getting out of Peloton, getting out of the recession concerns. And now we're going to go towards our oil analyst today. And a lot of this is we want to talk about what's going on right now, right? Like always. One thing is we can go ahead and catch it as it hits the tape, but there's another thing getting to the expert opinions. So if you guys have questions on what's been going on in the oil markets or maybe in commodities, let me know. And I'll definitely try to go ahead and get your question answered right here on Stock Market Movers. Let's go towards our second guest of the day. All right, let's bring Rob Thummel here, Senior Portfolio Manager and Managing Director at Tortoise Capital Advisors. Welcome on.
Thanks for having me.
Welcome back, Rob. Let's get into first. Everyone wants to know what's going to happen. What effects does the new production cuts from OPEC Plus decision have on the price of oil?
Yeah, so I think the effect of production cuts probably already been priced into oil in general. If you think about, I know the headline was big, 2 million barrels a day cut, biggest cut since 2020. But when you look underneath the hood a little bit more and dig into that, that 2 million is based off of a baseline, and half the companies OPEC actually aren't even producing to their baseline. So really the cuts are only going to be made by really three primary countries, Saudi Arabia, Kuwait, and the UAE. And that's only going to be take about 1 million barrels a day of physical volumes off the market. So it's not quite as big as the headline indicates. And then if you think, well, why do we need to take 1 million barrels off the market? Well, because China demand this year, as we all know, everything in China has been shut down. So China oil demand typically grows 600, 700, 800,000 barrels a day this year. It's actually going to be negative growth this year. So really what OPEC has done is offset the supply and will produce less to offset the demand that's coming from China that's not going to be there. So they'll reassess in a couple months, see where China is, see where the rest of the world is in terms of this recession and concerns about the recession, and then potentially raise production if necessary. Bottom line is, I don't expect prices to just materially rise as a result of this particular decision made by OPEC yesterday.
Of course, Biden coming out and saying he's disappointed in the OPEC Plus decision and looking at options. So what really can the White House do here to combat the OPEC Plus cut?
Yeah, so I think a couple of things that the White House is considering. Number one, continuing to draw barrels, take U.S. oil out of the Strategic Petroleum Reserve, which is a U.S.-based reserve down in southern on the Gulf Coast. Continuing to add supply to the U.S. market that way has really reduced oil prices, has reduced gasoline prices, as we know. Since early June, gasoline prices actually declined by over 20%, oil prices down by 20%. So that has been effective. The other thing that the administration has considered is banning exports of refined products, gasoline, diesel, jet fuel, that typically happens in the Gulf Coast. I'm not sure that would be the best choice, because I just think that would raise the overall price ultimately. But those are a couple things that the Biden administration is contemplating as we speak today.
Now, I think you elated a little bit towards this, but why do you think OPEC truly made this decision to just cut production?
Yeah, no, that's a good question, and I think OPEC it tries to look at, I mean, they are, they represent 40% of the global oil supply when you counter or you factor in OPEC plus Russia and other countries. So they supply the world with 40 million barrels a day of oil, 40% of the supply. They have probably the best data of any of us as analysts in terms of what is global oil demand and how is it being impacted. And what they are seeing is lower demand as a result of the concerns about a recession, rising interest rates really around the globe, and that slowing economic demand. And when economic demand slows, then that trickles down into lower oil demand. And so I think OPEC's looking at that and seeing that the market is oversupplied and forecasting that oversupply will remain in place for a while, and are making short-term adjustments to reflect that oversupplied market, which means produce less so that supply and demand come back into balance.
Yeah, it seems like the battle's on there, and what's the best decision? Of course, everyone's going to have an opinion, but let's talk about how this will impact major oil stocks.
Yeah, so probably the best way to think about this is with OPEC's action, it probably sets a floor on oil prices. Let's just say $80. I know oil's 89, almost 90 today, but it probably sets a floor for oil prices, which makes it a little bit easier than to project forward what's the cash flow going to be for a lot of these oil stocks. And when you plug in $80 oil and $5 or $6 or $7 natural gas prices into financial models, what the result is a lot of cash flow for these oil and gas stocks that they're going to return to shareholders. Exxon recently announced a $30 billion stock buyback, right? They pay a dividend that's 3.5%. They're going to probably raise that dividend in November like they historically do. They've got very low debt levels. That's just one example. Just from a big macro perspective, the way I like to look at all stocks is what's the free cash flow yield of the stocks? In other words, how much cash do they generate? And the free cash flow yield for companies like Exxon and other energy companies is over 10%. And you say, well, what does that mean? Well, if you look at the free cash flow yield of the S&P 500, all those stocks collectively, it's about 5%. So the spread between energy stocks are trading at 10% free cash flow yield and the S&P 500 trading at 5% is just too wide. So how does that narrow? Well, I think the free cash flow is there. It's just the stock prices for energy are going to go up, in my opinion, and then as a result of that will narrow that differential and spread between the free cash flow yield of energy stocks and the S&P 500.
Now, a lot of people have been looking at these also for some income, right? Their dividends increasing. Do you feel that this is likely a trend to continue?
Yeah. So that's one of the great things about energy stocks, energy infrastructure stocks, the whole energy sector is the sector is delivering what really your clients are looking for right now, and that's income and lots of income. And so if you look at certain stocks like Energy Transfer Partners, or Plains All American that are more pipeline oriented stocks, they have dividend yields of 8-9%. And those yields are real. You're going to get paid that as an investor. You're going to get paid that as a cash payment, every quarter. And often those payments go up because these companies increase their dividends. So there are smaller yields, but even when you look at Exxon and Chevron, their yields are 3.5-4%, but that's still substantially higher than the S&P 500. That's 1.5%. So if you're looking for income, energy is definitely the place to be. Offers really attractive, compelling cash payments, basically on a quarterly basis that are growing to help offset any increases or rises in interest rates.
All right, let's pivot a little bit. Let's go towards natural gas. Of course, the situation definitely expanding. Don't know what happened there in Nord Stream 1 or 2. I don't think you have the answer for that either, but we'll definitely keep watching that. But what about like stocks like Cheniere Energy and how this will have an impact in the long run?
Yeah, Tortoise Cheniere is one of our largest holdings. It's been that way for a long time. A lot of people, Cheniere's become more of a household name. What is Cheniere? It exports natural gas and has the infrastructure, has built the infrastructure, and it's really helped the U.S. over the last several years become the largest exporter of liquefied natural gas, or LNG, in the world. That's obviously been amplified, or the significance of that has been really amplified this year based off what's happened to Europe and the impact of Russia. Europe needs a lot of liquefied natural gas to replace natural gas that was formerly came from Russia. And so Cheniere has actually exported a substantial amount of its liquefied natural gas to Russia or to Europe this year. And the thing about Cheniere is it just is really getting started as a company. It had to build all this infrastructure really over the last little less than decade, but now it's really shifted to being able to harvest a substantial amount of cash flow, generate a lot of cash flow, and pay that back to shareholders over the next several decades as the contracts that Cheniere has in place really take shape and customers continue to pay month after month, year after year, decade after decade, Cheniere to provide liquefied natural gas to facilities really all around the world, in Asia, South America, and in Europe as well. And so what that means then for the stock is the dividend will go up, the amount of stock buybacks are going to go up, and the debt's going to go down. And so you put those three together, we think that that's pretty compelling and a pretty good set looking forward for the Cheniere stock of continuing to rise from here.
Now, the last thing I'll leave off is more inflationary kind of concern here, right? Everyone has their mind on inflation. Will cuts like this kind of help keep inflation a little bit stickier in our kind of energy outlook?
Yeah, so if you look at from an inflation perspective, in the second quarter, oil prices declined over 20%. I think it was 26% technically, and so that obviously that's good for inflation, lower oil prices. The unfortunate thing is a lot of other things, food and rents and used car prices and new car prices didn't come down, so we saw continued higher inflation. I don't think you're going to see massive increases in the oil prices from here. Are they going to go down more? Well, I'm not sure. I don't necessarily think that they could go down a lot, but I don't think they're going to go up a lot either. And so I just think that muted effect won't have a huge impact on inflation from here. And then hopefully, we can see declines in things like rents and food and autos. And then combine that with the lower prices for energy in general since the second quarter. Those will all help take shape and bring inflation down in general going forward from here on out.
And I get a question from the chat, so I'll go ahead and see if you can answer this one. What do you think about EPD? So enterprise product part.
That's a great question. That's another high yielding energy infrastructure stock. Great stock. I've been investing in EPD for probably 17 years. It's a great company. It grows its dividend. It's grown its dividend, I think, 2 or 3% a year. Likely continues that. It owns really critical, really essential infrastructure. So we've been a big owner of enterprise products at Tortoise for a long time, and believe it's got significant opportunities in the future to export different products, energy products, but also to move energy products around the U.S. as well.
Perfect. We'll sneak one more here. Alan has a good question here. As EVs become more popular and electricity costs go up, how does the market react to that?
Yeah, so that's a good question, and we follow EVs very closely in adoption. So a couple ways to think about that for energy. Number one, you're going to need a lot more EV charging stations, right? And so that may be a new area for investors to take a look at, is EV charging, because there's going to be a lot of EV charging that's going to be necessary as EV penetration rate increases. As you highlight, though, you're going to need more electricity, right? And so where's that electricity going to come from? Well, if you start going back and back tracing the value chain, you're going to see that a lot of electricity in the U.S. comes from natural gas. You're going to need more natural gas to generate more electricity. And so that's why we're at Tortoise, have such strong conviction about the future of natural gas and its role both domestically to help obviously reduce carbon and decarbonize the U.S., but also to help decarbonize the rest of the world, because places like India and China, where they predominantly use coal to generate electricity, if they switch to natural gas, carbon emissions around the world would dramatically increase very rapidly. So that's really our perspective on EV penetration.
And just because the chat's going to kill me if I don't ask, any thoughts on the coal industry?
Well, so Tortoise, our motto or our view about energy in general is we're going to need more energy, but less carbon. And coal is a lot of carbon. So in general, what we'd like to see across the world is, we know population growth, GDP is going to grow, energy is essential to help all of that. So that's going to be the more energy, but to have less carbon, you just need less coal. And so coal is not an area where we really invest or allocate resources to. Obviously, prices are up a lot, stocks are up a lot, but if we're going to decarbonize, we're going to have to really have no coal.
All right. Well, thank you, like always, for coming on today, Rob, bringing in all different types of aspects from oil to natural gas, and also giving you an outlook into some of these major oil stocks. Thank you for coming on.
Thanks for having me.
Have a great one. All right, that's going to do it for us. We're going to start wrapping on up. I hope that you guys appreciated me asking questions that you guys gave in the chat. That's truly where we get the competitive advantage, right here on Benzinga, because at the end of the day, if you're watching some of the other networks, what would you be left? Probably with a question. Here, you got some answers, and that's what it's truly all about right here on Benzinga's Stock Market Movers. I'm your host, Money Mitch. I hope that you guys enjoyed today's show. We had a lot of conversations, and there's still more headlines out there to talk about. So definitely look out there at all the analyst ratings that are out there. There was a great one that I thought was interesting, which was a downgrading on Silvergate Capital from Wells Fargo. Goldman Sachs coming out with some ratings out there. Steel Dynamics, Pinterest, Take-Two. A lot of ratings out there. So go ahead and make sure that you take a look. If you want to also have a kind of feature for this, well, just look up Benzinga Pro. Go to pro.benzinga.com and you can get a 2-week trial. You don't even need a credit card. All right, guys, I'm going to go ahead and leave you guys on out here. Let me just make sure that we got the NFT coming on next, roadmap coming on next. I didn't see the kind of redirect set there. So just give me 1 second. Let me make sure that I have that set for you guys. And then we'll go ahead and get you guys over to the roadmap. That's what's coming on next. Looks like, let me go ahead and let me try to correct this. Don't see it there. All right, I'm just going to have to go ahead and wrap up. Like always, guys, we're going to keep battling here. I'll see you guys at 3:30. We'll see what happens at the close. I'll have Joel Conan. We'll take a look at the market. Will we hold on here? It seems like the market is trying to hang on here. But, of course, if it breaks down through that 374, I would watch out because the down action could come following that. I'll catch you guys next time right here on Stock Market Movers. Like always, hit the subscribe button and hit the thumbs up if you guys enjoyed today's show. Hope you guys appreciated getting through a bunch of headlines and, of course, expert opinions to keep you an informational edge. Hey, Pat M, I got you on Levi. I know I forgot it. Come to At the Close. I'll make sure that I talk about it right off the hop at the Close. That's at 3:30 p.m. Eastern. See you there.